Do you ever feel like preparing taxes is a big game and you're always losing? Or like once a year you gotta spend an entire afternoon making decisions in the dark with terminology-shaped obstacles flying at you from all directions? And at the end of the day, you don't have any confidence that your tax return was prepared properly? Well, chances are you're not alone. Taxes are confusing. In 2014, the Washington Times reported that the United States tax code is 3,951,104 words long. That's twice the length of the King James Bible and the complete works of William Shakespeare combined. That's long. The good news is the vast majority of people can skip most of this when preparing their own taxes. In fact, once you understand the basic fundamentals of preparing returns, then the details and exceptions become a whole lot more manageable. So here it goes. Clear your head, forget all the details, and think big picture. The rule is relatively simple, and there are just 3 equations and a few vocab words that you need to know. Don't worry, there won't be a test. You will have to do your taxes though, which is kind of like a test, but it's gonna be fine. Okay, here's the first equation. Adjusted gross income minus deductions and exemptions equals taxable income. Gross income just means total income before taxes. Adjustments, deductions, and exemptions are all different, but they're basically just ways to reduce the amount of your income that gets taxed by the government. We'll get to the specifics later. Once you figure out your taxable income, you just plug that into the next equation. Taxable income times tax rate equals your tax liability. The tax rate depends on your income, and your tax liability is the amount of taxes that you have to pay to the government for a single tax year. And now comes the great reconciliation. Your tax liability minus credits and payments. If what you've paid through credits and payments is less than your tax liability, then you owe money to the government. But if what you've paid through credits and payments is more than your tax liability, then you get money back. Yeah! Okay, so let's examine each of these 3 equations a little bit closer. First, we're going to talk about income. Over the year, you could get paid by various sources. Maybe you're a grocery store clerk, or a teacher, or a professional Easter bunny. Maybe you rent out your home or sell your art on the internet. Maybe you won the lottery, cashed out a retirement plan, Social Security, unemployment, pension payouts, the list goes on. All of this money, with very few exceptions, is considered income, and the government wants you to contribute your fair share so we can do all sorts of useful things like make roads and build schools and pay public officials. Okay, now for a few of those details that we skipped over before. There are a couple of forms that standardize the process of reporting income. You've probably heard of them. Almost all income will be reported on a Form W-2 or some type of Form 1099 that'll be issued by your employer or other third party, who will send one copy to you and one to the IRS. The exception is when your payments add up to less than $600 in a calendar year. In this situation, you might not receive a Form 1099, but you still have to report that income. Yeah. You do. Outside of Form W-2 and business income, other common types of income are Social Security, retirement benefits, and unemployment benefits. There's also self-employment income, which can get a little bit more complicated, so we're just gonna skip that for now. To calculate your total income, just add up all your W-2s and your 1099s and any extra cash income that hasn't been accounted for. Tax software will help you fill out all the minute details by asking you to enter in the information exactly as it appears on those forms. So like with all things taxes, as long as you understand the fundamentals behind the calculations, just let the computer deal with the details. If you want to know more about all the different types of income, there's a link below in the description. Okay, so after you've added everything up, the IRS allows you to subtract certain kinds of expenses from your taxable income. These are called adjustments, and they're awesome. You can claim adjustments even if you decide not to itemize your deductions. What? That's crazy! We'll get to that. Here's a few examples. Now, you don't have to memorize these, but just remember there are some adjustments that you can subtract from your total income to get your adjusted gross, oh wait, gross just means total, income. Now that you have your adjusted gross income figured out, you can calculate your taxes, right? Wrong. Dead wrong. First, you get to reduce your income even more through deductions and exemptions. Yeah. They represent the idea that, hey, it costs a little something to eat and stay alive, or to do things that the tax system encourages, like go to school, get married, have a family, buy property, that sort of thing. When it comes to deductions, you have a choice. You can 1, itemize your deductions, or 2, get the standard deduction. Itemizing is when you add up all of the expenses that the IRS will allow. Things like charitable donations, home mortgage interest, or weirder ones like the value of something someone steals from you. Seriously. Or it may be that the standard deduction is more than all of your itemized deductions combined. If that's the case, then get the standard deduction. Each year, the IRS makes adjustments to the standard deduction and publishes it like this. If you don't have some big expenses to itemize, chances are you'll take the standard deduction, especially if you're married or head of household. This brings us to exemptions. Exemptions are kind of like deductions, but they're actually a lot simpler. It's basically an additional amount that a self-supporting taxpayer can subtract from their taxable income. You can claim exemptions as long as no one else can claim you as a dependent. In other words, if you are self-supporting. You get one exemption for yourself and one exemption for each person listed as a spouse or dependent on your tax return. Each exemption is worth the same amount. So let's say that you're married and you have 2 kids. That's 4 exemptions. Single but supporting your live-in dad, 2 exemptions. A student filing a tax return but being claimed by your parents as a dependent, 0 exemptions. Sorry, not self-supporting. A dude like me, 1 exemption. 1 very cool exemption. Then after you've adjusted and deducted and exempted everything you could possibly think of out of your total income, what you're left over with is your taxable income. Then you just plug that into the second equation. Your total tax or tax liability is just taxable income times tax rate. Your personal tax rate is determined by your income and it's progressive, so someone who makes very little might only pay 10% of their taxable income, while someone who makes more might pay 35%. The more you make, the more you pay. It's easy! So how do you know what your personal tax rate is? Simple. It's all published in a table on the IRS website and republished hundreds of times on other financial services sites. Of course, tax software will always handle the calculations for you. And there you have it. Your taxable income times tax rate equals your tax liability. In other words, what you specifically need to pay to the federal government. And that's all there is to it. See ya! No, wait, don't go. We're not done yet. This is actually the good part, so stick around. Let's take a look at that final equation. Just because you know how much you're supposed to pay in taxes doesn't necessarily mean that you owe all of that money at tax time. This is where some people get confused. If you receive a W-2, chances are you've had money taken out of your paychecks throughout the year. And great news! That counts towards what you owe. These are called payments, and they are added up and listed on your federal 1040. In addition to payments, some taxpayers, especially those with low to moderate income, are eligible for certain credits. Credits are great because they're applied directly to what you owe. Credits are there to reimburse you for things like going to college, saving for retirement, or paying for daycare while you work. One of the largest and most significant credits is called the Earned Income Tax Credit, or EITC, as you might have heard it called, because the IRS loves acronyms. Obviously. The EITC can amount to more than $6,000 towards a family's tax bill. That's huge! So big actually that it's credited, get it, with being one of the largest anti-poverty measures in the country. This is because after receiving the credit, families eligible for the EITC can actually go from one side of the poverty line to the other. So, if you add up all of your credits and payments throughout the year and they equal more than your tax liability, then you get a refund. Yeah! Yeah! Woo! If they're less than your tax liability, then you owe money. Boo. So, let's review. Taxes are scary. It's so confusing. I give up. No. Yeah, sure, it can get complicated. You might have to fill out extra schedules, but these are just additional forms that help you calculate more complex tax issues. There you have it. Adjusted gross income minus deductions and exemptions equals taxable income. Taxable income times tax rate equals your tax liability. Your tax liability minus credits and payments equals what you owe, or what you get back in a refund. If you can remember that basic structure, everything else is just details. Thanks for your time, and thank you for participating in the time-honored American tradition of paying your taxes. Yeah! If you would like to volunteer to provide free tax preparation for low and middle income taxpayers in the Chicagoland area, please visit our website at goletterup.org. All training is provided and no professional tax experience is necessary.